Yesterday, Iron reported their earnings, and this company is well known as kind of the Bitcoin mining and AI hybrid company. They get a lot of buzz for doing what they do. Today, their stock is up 0.5% after reporting earnings yesterday, so not much of a move, but this morning they were down by 3 to 4% in the early trading hours. So throughout the day, there's actually more buying pressure than selling pressure. So as a whole, it looks like investors liked this earnings report. However, I think that Iron could be getting themselves into a little bit of financial trouble. That's not necessarily my opinion. I'll show you the data and the facts, and I just don't think the management team is representing this well enough to investors, and I want to make sure everybody is aware of what's going on. I'm actually bullish on Iron's Bitcoin mining operations, but I think their AI play could kind of be the death of them. And again, I'll show you the numbers where I come up with that thesis. But let's cover their earnings release first and foremost. They reported record revenues and $53.7 million of operating cash flow. Really, really strong. They announced a 75 megawatt liquid cooled Childress data center for AI and HPC. They're developing a new 600 megawatt data center that they call Sweetwater 2. If we scroll down here, they'll show you they had a 129% increase in their Bitcoin mining revenue, which equated to $113.5 million compared to $49.6 million just a quarter ago. But they're not highlighting their AI HPC business for some reason. Why would that be? Well, I can show you basically their income statement. They report on IFRS standards, not GAAP standards. They're moving towards getting onto GAAP standards, accounting standards, and we'll talk about that in a little bit too. But here you see $113.5 million of Bitcoin mining revenue, up significantly quarter over quarter, but their AI cloud service revenue actually fell from $3.2 million to $2.7 million, and they continue to funnel hundreds of millions of dollars into AI and HPC. So analysts on their earnings call have started to put some pressure on the CEO here. Just simply because they're plowing hundreds of millions of dollars into AI HPC, but they have a single-digit revenue business to show for it. The CEO talks about all of the money that's going into AI inferencing, yet none of that money has been coming to Iron. Why is that? Iron even went out and hired Morgan Stanley as an advisor for their AI HPC business, but they failed to bring Iron any customers or future business, so they fired Morgan Stanley. So their AI business is kind of it's in standstill mode right now, and they failed to mention that their revenues actually decreased quarter over quarter in that revenue segment. And that's what's kind of dangerous here. Now, they did actually report a positive operating profit of $31.1 million. Couple of caveats to this. Obviously, very, very good thing if companies in the Bitcoin mining space can demonstrate operating leverage. The caveats, though, are they do depreciation on a 4-year schedule. A company like CleanSpark, which I own, they do depreciation on a 3-year schedule. So it's likely that Iron is kind of undershooting their depreciation numbers here. And that's a big piece of it. And then they had a $12.9 million gain on one of their financial instruments that was tied to their convertible notes. So if you strip those two things, or if you add, extra depreciation, normalize that depreciation and strip away that unrealized gain on their financial instrument, they basically had a scratch quarter when it comes to operating profit and income, which is actually a very good thing because a quarter ago they had an operating loss of $54 million. But I think the company is teetering on getting ahead of their skis when it comes to particularly the AI business. Why do I say that? Well, let's go to their balance sheet. And if we look at their balance sheet, one problem presents itself right away. Their total current assets, so their liquid assets they hold at the company, were $525 million as of the end of the quarter, but their total current liabilities were $559 million at the end of the quarter. So their current liabilities outstripped their current assets at the end of the quarter that it's reported on. That's not a healthy current ratio. And they're going to struggle to utilize their balance sheet to raise money as a result of that. Now, again, part of this, and this is where we get back into IFRS versus GAAP, part of this is they're required to report their convertible note debt here, the $318 million, as a current liability when it comes to IFRS standards, because as a result of that conversion feature, there is a chance that debt will become due within 12 months. That's why they're required to report it as a current liability. Now, if they do adopt GAAP principles, that's redundant, but if they do adopt GAAP, they'll be able to consider the convertible note as more of a long-term liability or a non-current liability, which is what your CleanSparks do. But still, this isn't a good look because I can compare this to CleanSpark's balance sheet. CleanSpark has a convertible note of their own of $640 million. You can see there it's a long-term liability for CleanSpark, and it's a current liability for Iris Energy, or IREN. It's not Iris Energy anymore, it's IREN. But let's say that, let's say CleanSpark's convertible gets triggered and they have to reclassify it as a current liability. Well, if you look at the total current assets that CleanSpark has on their balance sheet, it would still cover their current liabilities by around 2 times. So it's just interesting to compare CleanSpark's balance sheet and their ability to probably utilize their balance sheet moving forward to raise funds if they have to, versus IREN's ability right now. They don't have many current assets. They don't have many liquid assets because they don't hold on to the Bitcoin they mine. That's another downside of not having a HODL balance. Now, I don't think this is going to be an issue. It's just simply accounting. I don't think this is really the issue here with IREN. When they adopt GAAP, it'll be reclassified as a long-term liability, and their current ratio will look healthier again. But it still demonstrates that if they do have to convert the debt, they don't have liquid assets to cover the debt. Obviously, if the debt comes due, they're going to convert it into shares, just because that's what the most profitable thing would be to do. Now, as a result of this, though, IREN put in a statement in their going concern segment of their recent SEC filing. And they say the company has determined there is material uncertainty that may cast significant doubt on the group's ability to continue as a going concern. And this has a lot to do with that current liabilities being greater than current assets currently on the balance sheet. But they do talk about how a decline in the market price of Bitcoin, increases in the difficulty of Bitcoin mining, changes in the regulatory environment, and or adverse changes in other inherent risks may significantly negatively impact the group's operations. There can be no guarantee that future mining operations will be profitable or the group will be able to raise capital to meet growth objectives. Now we're starting to get into it, where IREN, they need to raise capital in order to meet their growth objectives. Otherwise, their business model completely fails. Now, diving a little deeper into this, in that same SEC filing, they talk about two events that happened after the reporting period. On January 2nd, so literally the very first day they were able to do this after their quarterly report, they exercised their option to buy 48,000 S21 Pro mining rigs and 30,000 S21 XP mining rigs, and they spent $411 million on that purchase option. However, a few weeks later, on January 22nd, they also decided to upgrade part of their existing fleet with 9,000 S21 XPs, and they spent an additional basically $36 million to do this. So all in all, they just spent $447 million on Bitcoin mining rigs to reach their growth objectives. Why is this potentially a problem? Well, if we go back to their balance sheet, at the end of last year, as of December 31st, they only had $427 million of cash on their balance sheet, despite raising proceeds from that convertible debt during the quarter. They were down to $427 million. And literally just a couple of days after December 31st, they went out and they spent $447 million on their Bitcoin mining rigs. That's kind of a problem. You might be asking, well, if they didn't have cash to do that, where are they getting this cash? Well, recently, they announced a $1 billion at the market dilution program, essentially is what it is, where they can dilute shareholders up to $1 billion. This is where they're getting their cash to do this stuff, but that's the problem. They're 100% reliant at this point on future dilution to fund their business. And what did they just mention in their going concern? That if they fail, if Bitcoin prices go down, they could fail to raise enough capital to meet their growth objectives, and their business model could fail. I mean, that's a significant risk here because, Iron, they don't have the ability to really leverage their balance sheet from this point going on because they don't have the liquid assets on their balance sheet to leverage any sort of debt that they want to take on. Let's just say Bitcoin takes a 50% haircut, which it's done that before, even in bull markets. Iron would be in trouble because they'd be diluting shareholders to fund the growth of their business and keep their business operational as their business is worth less and less money. It's kind of what you call the dilution death spiral. Versus a CleanSpark who has, let's say, as of today, they have basically $1 billion of Bitcoin on their balance sheet. If Bitcoin takes a 50% haircut, the value of their Bitcoin on their balance sheet would be $500 million, but they still would have the ability to cover all of their current liabilities, even if their convertible note had to be reclassified as a current liability. CleanSpark has far more liquidity and far more ability to leverage this balance sheet. So it's safe to say, if we look at the fact that Iron had $427 million of cash at the end of 2024, and a few days later they spent $447 million, they've now spent every single dollar of cash that was previously sitting on their balance sheet. And the management teams will play this game. You know the reason why they waited till January 2nd to do that, to make these moves? It's because if they did this prior to quarter end, all of a sudden they report cash next to $0 on their balance sheet, and their current ratio looks even worse, and their balance sheet looks even worse. So the management team is kind of playing a game here of optics where their balance sheet looks okay as of December 31st. But if they showed us a snapshot of their balance sheet today, it's not looking nearly as healthy. Now, sure, the mining rigs they purchased, they're going to go into their PP&E, property, plant, and equipment. It's going to add assets to the balance sheet, long-term assets to the balance sheet. But these are assets that, again, you depreciate relatively rapidly. And that's actually the bigger problem. This keeps getting a little bit deeper. If we look into Iron's CapEx during the previous 6 months, and I know my face is kind of covering this, I'll just tell you, based on their change in total property, plant, and equipment, the value of that, they had $768 million of capital expenditures just in the previous 6 months alone. And actually, you'd have to add back all of this accumulated depreciation to get the true spend, the true CapEx here. So you're probably closer to $850 million of CapEx in the last 6 months alone. And because of Iron's planned growth, we have to anticipate that they're going to spend at least the same amount in the coming 6 months, another $850 million of CapEx. Where are they going to get that money if they don't have it sitting on their balance sheet? Well, again, it's this $1 billion ATM, which that's going to be fine. The ATM is going to be fine as long as Bitcoin prices cooperate. And that's kind of the going concern. Again, if Bitcoin prices fall 50%, Iron's ability to raise money goes way, way down. And that's when the business kind of gets at risk here. So this is somewhat problematic. If they spend $850 million of CapEx over the next 6 months and their ATM just has the ability to dilute $1 billion, they're going to tap out this ATM in probably less than 12 months. At that point, where are they going to get more money to spend to grow their business? I don't know. It depends on market climate. Could they issue another ATM program? Yeah, they probably could. But man, shareholders right now are going to be fleeced by the ATM programs moving forward. And that's kind of, at least in my opinion, that's problematic. And especially, we look at Iron's business model, and this was just announced the other day, they're going to build out, or at least they changed they're going to build out a 75 megawatt liquid cooled data center for AI and HPC. They're going to spend $300 and $350 million in CapEx on this project, and it'll be completed by the second half of 2025. So you ask me, I mean, I'll ask you, you ask me is what I said. If they have an HPC AI business that's, doing single digit millions in revenues, and they're spending $350 million to develop this infrastructure, what's your payback period there? When do investors actually see the return on investment? And that's what Iron's management team was taking some heat for in the earnings call. And this isn't a very healthy business model. They're building this new data center to support NVIDIA's Blackwell GPUs for 200 kilowatt rack density. If you're telling me that with every new NVIDIA GPU or new NVIDIA GPU platform, we need new data centers because the prior data centers don't have enough rack density, every time they release a new GPU, you have to build a new data center to have the proper rack density, that's a problem. That is not a healthy business model at all. All of this begs the question, and they talk about Horizon 1 there. They talk about their 2 gigawatt Sweetwater data center, Sweetwater 2, which is another 600 megawatts. It begs the question, is Iron getting into some sort of financial trouble here? Iron needs their HPC AI business to succeed, but they have yet to sign any legitimate customers or strong contracts, and they're doing single-digit millions in revenue, and they've spent hundreds of millions of dollars on AI HPC infrastructure. That's kind of a problem, and they have a $1 billion ATM. You know why it's $1 billion? It's because they need $1 billion in order to continue to operate the business. If the price of Bitcoin takes a 50% haircut, this threatens Iron's business model a lot, much more than it threatens a CleanSpark's business model, for example. And that's the question we have to ask. If there's no chance of their HPC AI business succeeding without hundreds of millions of dollars of additional spend, and we really don't know when the ROI is going to come from all of that spend, at a certain point, I know Iron's been the hot name. It's been a hot stock, but at a certain point, investors they're going to start to question that, and the amount of funding they have is kind of drying up because they don't have a balance sheet to keep leveraging and taking on more debt, so they're reliant on an ATM. So and right now we talked about, if you look at a current snapshot of their balance sheet, because they just spent $447 million on new Bitcoin mining rigs, if they sent you a snapshot of their balance sheet today, investors would panic. And that's why they waited until the new year to take on that spending. So I don't know. That ATM, they have to hit it hard. There's people out there that say, oh, they haven't the ability to dilute by $1 billion, but they won't do it. Yeah, that's bullcrap, because they have to dilute the full $1 billion. I mean, just over the last 23 days, they diluted shareholders by $50 million. And if they spend all this money on PP&E moving forward and developing this infrastructure, they're going to need to dilute shareholders by $1 billion. So anyways, again, I'm bullish on their Bitcoin mining operations. I just think it's right now, with the way the business is set up, it's kind of it's a little bit of a house of cards. They have a very healthy Bitcoin mining business. No refuting that. But because of all of this planned spend, and because they don't have a HODL balance, and because there's zero ROI on their HPC and AI, it's hard for me to wrap my head around this investment opportunity today. I know they have megawatts. I know they have land, but where are the customers? Where are the contracts? We can talk about the megawatts and the land all day long, but where are the clients? Morgan Stanley couldn't bring Iron business. They fired him. So where's the business going to come from? Where's the business going to come from? At a certain point, if the business doesn't come, Iron has to cut their CapEx spending or they won't make it. They won't make it. And again, if Bitcoin falls in price, that could be it for Iron. And I don't know if that risk is being laid out very well right now. With that, let me know your thoughts on this down in the comments section below. I tried to provide as many factual numbers as I possibly could in this video, but if you disagree with me or if you see something that I don't see that would refute anything I said today, please let me know that as well. I'm always open to new thoughts and opinions. If you are new here or returning not yet subscribed, please subscribe down below. Hit the like button for me while you're down there. And with that, have a great rest of your day. Stay blessed. Keep 10 toes grinding your chin up. Peace out.